In this video, we're diving into something that's at the heart of every auditor's ethical decisions: independence. Independence ensures that you remain objective, unbiased, and most importantly, trusted by everyone who depends on your work. Imagine you're an umpire at a baseball game. You can't be rooting for either team, right? Your job is to call the game fairly without any personal bias. Independence in auditing is like being that impartial umpire. You're there to call the shots based on the facts, not on relationships or personal interests. Believe it or not, the set of rules, or let's call them playbooks, auditors work with are different depending on whether you're a private company auditor or a public company auditor. Auditors who are conducting a private company audit must follow the audit standards of the Audit Standard Board, ASB, or generally accepted auditing standards, as well as the standards of professional conduct by the AICPA, as well as the Independent Standards Board. Public company audits follow the auditing standards by the PCAOB, which are actually very similar with a few notable exceptions to the AICPA standards. Public company audits also follow the standards of professional conduct by the PCAOB, SEC, and ISB. The Independent Standards Board was a cooperative effort between the AICPA and the SEC. The board no longer exists, but the standards apply. Our focus today is going to be the AICPA Rules of Conduct and specifically Rule 101, Independence. But let's first level set where the rules of conduct fit in terms of the AICPA Code of Professional Conduct framework. The framework starts with 6 principles of professional conduct, which are responsibilities, public interest, integrity, objectivity and independence, due care, and scope and nature of services. These principles of professional conduct apply to all members, regardless of whether the accountant audits companies, prepares tax returns, works for a private company, or is an educator. These principles flow to the rules of conduct, and from the rules of conduct, we get more granular in terms of interpretation, as well as rulings by the Professional Ethics Executive Committee. There are 11 rules of conduct, which are independence, integrity and objectivity, general standards, compliance with standards, accounting standards, confidential client information, contingent fees, acts discreditable, advertising and other forms of solicitation, commissions and referral fees, and forms of organization and name. Today, we'll discuss Rule 101, Independence. Rule 101 states that a member in public practice shall be independent in the performance of professional services. That includes those who perform financial statement audits, statement reviews, and attestation services. The interpretations for Rule 101 provide us with even more details that state that covered members must be independent. Think of a covered member as someone who gets an exclusive invite to the Independence Club. Only those who directly influence the engagement are included. It's like being on a VIP list for a special event. Who makes it onto this list? There's the attest engagement team, meaning the auditors who are directly working on the audit. Key influencers, which includes those who have the power to impact the audit's outcome, like for instance, the senior partner overseeing the audit. The firm itself and any company whose policies can be influenced by the covered members. Prohibited relationships in terms of an auditor's independence are financial or personal relationships that could compromise the auditor's objectivity or create a conflict of interest. Rule 101 distinguishes between direct and material indirect financial relationships. Think of direct financial relationships as a no-fly zone. You own stock in the company you're auditing. You're too close to the action, like a fan trying to umpire a game for their favorite team. That's a direct conflict of interest. The result? You can't be independent. So what are indirect material financial relationships? If you own stock through a mutual fund and that stock represents a material amount of your wealth, you've crossed into risky territory. It's like owning a piece of the team, but pretending you don't. Still a conflict. There are some exceptions, though. Some loans, like auto loans or loans secured by life insurance, don't automatically break independence as long as the balances are under certain thresholds. Independence can also be impaired if an auditor or a member of the audit team has previously served in a managerial role or influential role in the company or subsequently accepts employment with a client. For instance, let's say you're an auditor at a big firm and your partner who is also working on the engagement just got a role as a CFO at a client company. Guess what? That's a red flag for independence. Your firm is no longer considered independent for that audit because of the relationship between your colleague and the client. The member's immediate family are included in the covered member rules, including spouse, spousal equivalent, or dependent, is subject to Rule 101 and its interpretations. Imagine your spouse is the CFO of the company you're auditing. Well, in the independence world, this is a big no-no. You can't audit a company if your immediate family members, like your spouse or dependent, hold significant positions or investments with that company. It's like being the referee and having your sibling on the other team. No matter how much you want to call it down the middle, it's hard to stay impartial. Litigation can impair independence. If there's a dispute between the client and the auditor, like for instance, the company suing the auditor for faulty work, or if you're suing the company for fraud, independence is shot. It's like trying to referee a game while arguing with one of the teams. It just doesn't work. Another situation might be you're auditing a company and they're threatening to sue your firm for not catching a big mistake in the financials. You can't continue working on that audit. You're too involved emotionally and your objectivity is compromised. The AICPA Code of Professional Conduct also restricts the type of non-audit services that can be provided to attest entities. And the SEC is even more restrictive in terms of independence rules for audits of public companies, meaning those trading on the exchanges. The PCAOB and SEC have 9 prohibited non-attest categories of services. This means that the audit firm cannot provide these services to the publicly traded company if they're also handling the audits. These prohibited services include bookkeeping, actuarial services, broker or dealer, financial information system design and implementation, internal auditing, outsourcing services, legal services, appraisal or valuation services, management functions or human resources, and expert services. Independence isn't just about avoiding a conflict of interest. It's about maintaining trust. When you're auditing, you're not just checking numbers, you're safeguarding the public's trust. Think of your independence as a tool used precisely and carefully to ensure that all decisions and judgments are based on facts, not relationships or personal bias. In the end, Rule 101 is your ethical foundation. It ensures that the work you do as an auditor is above reproach, transparent, and trusted by clients and the public alike. Independence isn't just a rule, it's the bedrock of your professional reputation and the trust that people place in the profession. So next time you're faced with a challenging situation, ask yourself, is this something that would put my independence at risk? If the answer is yes, it's time to step back and reassess.